Have you ever dreamed of a future where your money works for you, not the other way around? A future where you have the freedom to live life on your own terms? For many people, that dream feels distant, like something reserved for the lucky few. But I'm here to tell you it's closer than you think. Real estate investing isn't just about buying and selling houses, it's about building a foundation for lasting wealth. It's a tangible, proven path that has created more millionaires than almost any other strategy. It's not a get-rich-quick scheme, but with the right knowledge and a solid plan, it can be your get-rich-for-sure strategy. The beauty of real estate is that it's something we can all understand. We all live somewhere, we all know what a kitchen, a bathroom, and a bedroom are. This isn't some abstract stock or complicated financial instrument, it's a physical asset, something you can see, touch, and improve. The secret isn't some hidden trick, it's about understanding the 4 key pillars of real estate wealth. These are the engines that will drive your portfolio forward: appreciation, tax benefits, cash flow, and leverage. Each one is powerful on its own, but when you combine them, the results can be truly life-changing. Appreciation is the first and most well-known way to make money in real estate. It's simply the increase in your property's value over time. There are 2 main types, and understanding both is key to maximizing your returns. The first is natural appreciation. This happens without you lifting a finger. It's driven by factors like inflation, population growth, and the overall desirability of a neighborhood. The real magic, where savvy investors create massive value, is in forced appreciation. This is where you take direct control and actively increase the property's worth. You force the value up through smart improvements and strategic management. This could be anything from a cosmetic renovation like updating a dated kitchen or bathroom to a major project like finishing a basement to create a legal secondary suite. Another powerful way to force appreciation, especially in multifamily or commercial properties, is by increasing the net operating income, or NOI. The NOI is all the income a property generates, minus all the operating expenses. The value of these properties is often directly tied to their NOI. Let's make this real with a simple example. Imagine you find a duplex for sale for $500,000. It's a bit tired with outdated finishes, and the rents are below market value. Each of the 2 units is currently rented for $1,200 a month, bringing in a total of $2,400 in monthly income. The property is functional, but has a lot of untapped potential. You see an opportunity not just to buy a property, but to execute a plan that will significantly increase its value. Your plan is to invest $50,000 in renovations. You'll update both kitchens with new countertops and modern cabinets, replace the old carpets with durable laminate flooring, and give both units a fresh coat of paint. These are cosmetic, high-impact upgrades that tenants love. Because the units are now freshly renovated and much more appealing, you can justify raising the rent. After the renovations are complete, you're able to rent each unit for $1,700 a month. Your total monthly income has now jumped from $2,400 to $3,400. Now here's where the magic of forced appreciation really shines. By increasing your annual income by $12,000, that's $1,000 extra per month times 12 months, you have dramatically increased the property's value. If the average cap rate in your area is 5%, you simply divide the increase in NOI by the cap rate. In this case, $12,000 divided by 0.05 equals a staggering $240,000 increase in value. So let's do the final math. You bought the property for $500,000 and invested $50,000 in improvements for a total investment of $550,000. But by increasing the income, you've boosted the property's value by an estimated $240,000. You spent $50,000 to create $240,000 in new equity. That's the power of forced appreciation. One of the most overlooked but incredibly powerful benefits of owning investment real estate is the tax advantages. The government provides incentives for people who provide housing, and one of the biggest is depreciation. In the eyes of the tax authorities, a building wears out over time. Even though your property is likely appreciating in market value, you get to deduct a portion of its value from your taxable income each year as a paper loss. This is a non-cash expense, meaning you don't actually spend any money, but it still reduces your tax bill. For residential rental properties, the standard depreciation schedule allows you to write off the value of the building, not the land, over 27.5 years. Let's say you buy a property for $350,000. The land might be valued at $75,000, and the building at $275,000. you would divide the building's value by 27.5, which gives you a depreciation deduction of $10,000 every single year. If your property generates $15,000 in positive cash flow for the year, you can use that $10,000 depreciation deduction to offset it. Now, you only have to pay taxes on $5,000 of profit, not the full $15,000. But it gets even better. Savvy investors can use a strategy called a cost segregation study to accelerate depreciation. This involves hiring an engineering firm to analyze the property and identify components that can be depreciated over a shorter lifespan, like 5, 7, or 15 years, instead of the standard 27.5. Things like carpeting, appliances, and landscaping fall into this category. By accelerating depreciation, you can take much larger deductions in the early years of owning the property. This can significantly reduce or even eliminate your tax liability on the rental income, freeing up more cash for you to reinvest. These tax benefits are a huge part of the wealth-building equation. Every dollar you don't have to send to the government is a dollar you can use to pay down your mortgage faster, save for your next down payment, or make further improvements to your property. Appreciation is fantastic for building long-term wealth, but cash flow is what pays the bills today. Cash flow is the money left in your bank account each month after you've collected all the rent and paid all the expenses. This includes your mortgage payment, property taxes, insurance, maintenance, and any property management fees. If your income is greater than your expenses, you have positive cash flow. This is the ultimate goal for any income property investor. Let's look at a simple scenario. You own a rental property that brings in $2,000 in rent each month. Your total monthly expenses are $1,600. This breaks down into a $1,200 mortgage payment, $200 for property taxes, $100 for insurance, and you set aside $100 for future repairs. That leaves you with $400 in positive cash flow every single month. That's $4,800 a year of extra income that you receive just for owning the asset. It might not sound like a fortune, but this is just from one property. Imagine owning 2, 5, or even 10 properties all generating similar cash flow. Positive cash flow does more than just put money in your pocket, it provides a critical safety net. When unexpected expenses pop up, and trust me they will, your cash flow is there to cover them without you having to dip into your personal savings. Furthermore, consistent cash flow makes you more attractive to lenders. When you go to apply for a loan for your next property, banks will see that you can successfully manage your investments and generate a profit, making them more willing to lend you money and continue your growth. Moreover, that steady income provides you with options and flexibility. You can use the extra cash to pay down your mortgage principal faster, which builds equity and increases your cash flow even more over time. Or, you could save it up for the down payment on your next property. This is how you scale your portfolio. Leverage is perhaps the most powerful and least understood concept in real estate investing. In simple terms, leverage means using borrowed capital, usually from a bank, to buy an asset. It allows you to control a large, expensive asset with a relatively small amount of your own money. If you were to buy stocks, you would typically need to pay 100% of the value in cash. But with real estate, you can often buy a property with a down payment of just 20% or even less in some cases. You are controlling a $500,000 property with only $100,000 of your own cash. The other $400,000 is the bank's money. This is powerful because you get to benefit from 100% of the property's appreciation, even though you only put down 20% of the purchase price. Let's go back to that $500,000 property. If it appreciates by 5% in 1 year, its value increases by $25,000. That $25,000 gain is all yours. But think about it in terms of your initial investment. You made $25,000 on your $100,000 down payment. That's a 25% cash-on-cash return from appreciation alone, not even counting your cash flow or tax benefits. Without leverage, if you bought a $100,000 asset with cash and it grew by 5%, you would have only made $5,000. Leverage also magnifies the benefits of your tenants paying down your mortgage. Every month when your tenant pays rent, a portion of that payment goes toward paying down your loan balance. This is called amortization. Essentially, your tenant is buying the asset for you over time, piece by piece. You put down the initial 20%, and your tenant covers the payments on the other 80%. As the loan balance decreases, your equity, the portion of the property you truly own, increases. This happens automatically every single month, building your wealth in the background without you having to do anything extra. Of course, leverage is a double-edged sword and must be used responsibly. It magnifies gains, but it can also magnify losses if the property's value declines. This is why it's so important to invest for cash flow. If your property is generating positive cash flow every month, you can weather any temporary market downturns. You can continue to make your mortgage payments and hold the asset until the market recovers. We've covered the 4 essential pillars of real estate wealth: appreciation, tax benefits, cash flow, and leverage. As you can see, each one is a powerful engine on its own. Appreciation grows your net worth over time. Tax benefits like depreciation protect your profits and let you keep more money working for you. Cash flow provides you with steady income and financial stability, and leverage allows you to control large assets and amplify your returns. But the real transformative power comes when you get all 4 of these pillars working together in a single investment. That is the true secret to building generational wealth through property. Think about it. You use leverage to buy a property with a small down payment. You then force appreciation through smart renovations, immediately increasing your equity. Those renovations allow you to increase the rent, creating strong positive cash flow that pays your mortgage and puts money in your pocket. At the end of the year, you use depreciation to shelter that cash flow from taxes. Your tenant is paying down your mortgage, building your equity further, while the property's value continues to grow naturally over time. It's a beautiful, self-sustaining cycle of wealth creation. The path to becoming a successful real estate investor starts with education. You're already taking the most important step right now by learning these core principles. Continue to read books, listen to podcasts, and talk to other investors. Your knowledge is the one tool that will protect you from bad deals and guide you toward great ones. Don't be afraid to start small. Your first property doesn't have to be a massive apartment building. It can be a simple duplex, a house with a basement suite, or even just renting out a spare room. The key is to get in the game. The dream of financial freedom is not just a fantasy, it is an achievable goal. With the right strategy and a commitment to learning, you can build a real estate portfolio that will provide for you and your family for years to come. The opportunities are out there right now, waiting for someone with the vision and courage to seize them. So, take this knowledge, build your plan, and start your journey. The best time to invest in real estate was yesterday. The second best time is today. Your future is waiting.